Welcome back to the Global Ledger. I'm Justin. Most discussions of valuation cycles focus on growth, earnings, and interest rates. Those factors matter, but they are not the transmission mechanism. What actually drives valuation cycles is something deeper and less visible. That is the availability of balance sheet capacity, funding, and liquidity across the financial system. Today's episode is about how valuation cycles really work, not as abstract math problems, but as outcomes of changing financing conditions. This is where asset pricing stops being theoretical and starts being structural. Let's get into it. Traditional valuation thinking explains cycles kind of like this: strong growth, higher valuations; rising rates, lower valuations; higher uncertainty, wider risk premiums. That framework is useful, but a little bit incomplete, because it treats markets as if they are always liquid and always funded and always able to absorb risk smoothly. In reality, markets are intermediated systems. Assets are priced not just on expectations of cash flow, but on whether those assets can be financed, hedged, and held by balance sheets. That distinction is everything. Let's look at valuation as a financing problem for a second. Every asset price reflects two questions. Number one, what do I expect this asset to produce over time? Okay, that's number one. Number two, can I carry this position safely while I wait? Okay, so those are the two questions. Valuation models focus heavily on the first question, but markets care just as much about the second. The cost of carrying risk depends on funding availability, collateral quality, market depth, dealer intermediation capacity as well. So when financing is easy, risk starts to look cheap. When financing tightens, risk becomes expensive quickly. Valuations adjust after financing conditions change, not before. How does liquidity enter the discount rate? We need to bring this up. The discount rate is often described as a risk-free rate plus a risk premium, but in practice, it also embeds something else: a liquidity and funding premium. Okay, so this premium is rarely modeled explicitly, but it's always present. When liquidity is abundant, spreads compress, required returns decline, right? But when liquidity contracts, required returns jump, leverage is forced lower. The discount rate does not drift gradually. It reprices discontinuously. So that's why valuation cycles feel sudden and violent. I think the true valuation cycle these aren't just business cycles. I think they're financing cycles. They typically follow a sequence, with phase one being kind of an expansion, where funding is cheap, balance sheets are growing, risk appears manageable, and valuations rise faster than fundamentals, okay? And then into a second phase, which is more saturation, right? Leverage increases, assets are priced for stability, okay? And then onto a third phase, which I would call the stress phase. This is where funding terms start to tighten, collateral is reassessed, and market depth starts to thin. And then contraction, forced delevering, correlation spike, valuations compress rapidly. I think that would be the fourth phase. Valuations don't fall because investors seem to change their minds or anything like that, but because the system can no longer carry the same amount of risk. One of the most consistent patterns in finance, I think, is risk appears lowest just before it rises sharply. Why is that? Because abundant liquidity suppresses volatility, narrows spreads, Delays price discovery. This makes traditional risk metrics look reassuring, right up until they fail. The problem isn't bad modeling. It's modeling the wrong thing. Risk is not volatility. Risk is the ability to finance and unwind positions under stress. This explains several common puzzles as to why valuation moves after liquidity moves. Why markets rise during tightening cycles. This explains why bad news sometimes pushes prices higher. Why cheap assets keep falling. Why fundamentals lag price action. So valuations are reactive. Liquidity is casual. Once financing conditions shift, prices adjust whether or not earnings have changed. Here's a better way to think about valuation. If you want to understand valuation cycle, ask yourself, who is funding this asset? At what cost? Using what collateral? With what maturity? And through which intermediaries? These questions reveal far more than multiples ever will. Because valuation is not just about value. It's about carry. Valuation cycles aren't mysterious. They are structural. They reflect changes in balance sheets, funding conditions, collateral confidence. So once you see that, markets stop looking irrational and start looking mechanical. I want to thank you for listening to episode 48 of the Global Ledger. We talked about valuation cycles and their structure, and just kind of reframing this a little bit, peeling back the layers, and just looking at it just a little bit differently than standard models and standard valuation theory. In the next episode, we're going to ask an important question that ties all this in. Who actually controls liquidity at the margin, and why that matters for markets worldwide? Once again, I'm Justin, and thanks for being here.